There is a mortgage payoff strategy that uses the mathematical structure of interest calculation against itself, redirecting money that would otherwise disappear into decades of compound interest and returning it to your principal balance instead. The strategy does not require you to earn more money. It does not require you to make extra mortgage payments. It does not require you to refinance. It requires you to change where your money sits between the time you earn it and the time you spend it. And that change, applied consistently, can compress a 30-year mortgage into 5 to 7 years without increasing your total monthly expenditure by a single dollar. The mathematical principle behind it has been understood by banking professionals for over a century. It is precisely how banks manage their own short-term liabilities. And yet, no mortgage lender has ever sat across from a borrower at a closing table and explained it. The strategy is called velocity banking. The financial instrument at its core is a home equity line of credit, commonly called a HELOC. And the mechanism it exploits is the difference between how a mortgage calculates interest and how a HELOC calculates interest. Your mortgage calculates interest monthly on the entire remaining principal balance at the beginning of each month. Your HELOC calculates interest daily on your average daily balance. These two different calculation methods, applied together with a disciplined cash flow strategy, create an arbitrage opportunity that most homeowners are sitting on without knowing it. Welcome to the Invisible Ledger. If these stories matter to you, hit subscribe and the bell. This is where we trace the money they told you not to follow. To understand velocity banking, you first need to understand the amortization structure of a standard mortgage, because the way your bank presents your mortgage payment is specifically designed to obscure the true cost of the interest you are paying. On a $300,000 30-year mortgage at 7%, your monthly payment is approximately $1,996. In month one, approximately $1,750 of that payment goes to interest. Approximately $246 reduces your principal. The interest portion is calculated as 7% divided by 12 months, which is 0.583%, multiplied by the $300,000 balance. As your principal decreases, the interest portion decreases, and the principal portion increases. But this process is agonizingly slow. At the end of year 5, you have made approximately 120 payments totaling around $240,000. Your remaining principal is still approximately $278,000. You have paid $40,000 in principal reduction and approximately $190,000 in interest over 5 years of making full payments. The HELOC operates on an entirely different calculation structure. A HELOC is a revolving line of credit secured by your home equity. Unlike a mortgage with a fixed monthly payment, a HELOC allows you to draw funds, repay them, and draw again, similar to a credit card, backed by your home equity. The interest on a HELOC is calculated daily on the actual outstanding balance. If your HELOC balance is $50,000 on day 1 and you deposit your salary of $8,000 on day 15, your average daily balance for that month is lower than $50,000 by a meaningful amount. Every dollar sitting in the HELOC account is working against the interest calculation every day it sits there. The velocity banking strategy works as follows. You open a HELOC on your home. Most lenders require at least 20% equity to qualify, and HELOC rates in 2024 range from approximately 8 to 11% for variable rate lines, which is higher than many fixed rate mortgages. You make a large lump sum payment called a chunk from your HELOC toward your mortgage principal. If your HELOC limit is $50,000, you send $50,000 to your mortgage lender as a principal reduction payment. Your mortgage principal drops by $50,000 immediately. The interest savings on that $50,000 over the remaining life of the loan are substantial. At 7%, eliminating $50,000 of principal early in the loan life eliminates roughly $100,000 or more of future interest payments. Now your HELOC is $50,000 drawn. You deposit your entire monthly income, say $8,000, directly into the HELOC. Instead of a checking account where your money sits idle, every dollar of your income immediately reduces your HELOC balance and therefore reduces the daily interest calculation. You then draw from the HELOC throughout the month to pay your living expenses, your bills, your regular mortgage payment. Because your income exceeds your expenses, assuming positive monthly cash flow, your net HELOC balance decreases each month. When the HELOC is paid down sufficiently, you make another large chunk payment toward your mortgage principal, and the cycle repeats. Before I go further, this video is just the surface. Inside the Invisible Ledger Vault, you will find the complete velocity banking calculation worksheet, the HELOC qualification guide, the monthly cash flow analysis template, the interest rate comparison calculator, and the amortization compression table showing exactly how many years are eliminated at different chunk sizes and cash flow levels. The link is in the description, but stay right here. The mathematical principle that makes this work is the concept of average daily balance. Every day that a dollar of income sits in your HELOC account rather than in a checking account, it reduces the interest accruing on your HELOC. Over 30 days, the interest saved from having your paycheck deposited to your HELOC rather than a checking account is small. But when that principal is applied to the dramatically larger principal balance of your mortgage, the effect compounds. The key variable is your monthly cash flow surplus, the amount by which your income exceeds your expenses each month. The larger your surplus, the faster you pay down the HELOC between chunks, and the more frequently you can make additional principal payments to your mortgage. The strategy requires a HELOC with two specific features. First, it should be an interest-only HELOC, or have a draw period where you can access the full credit line without mandatory principal payments beyond the interest. Most HELOCs have a draw period of 10 years, during which you pay interest only on the outstanding balance. Second, the HELOC should have no prepayment penalties and should allow unlimited draws and repayments without fees per transaction. Major banks, including Wells Fargo, Bank of America, Chase, and many credit unions, offer HELOCs to qualified homeowners. The qualification requirements typically include a debt-to-income ratio below 43%, a credit score above 680, and verified equity of at least 20% in the home. Rates are variable, typically tied to the prime rate plus a margin. If you have made it this far, you understand the velocity banking mechanism better than the vast majority of homeowners who will make 30 years of mortgage payments without ever questioning the mathematical structure they are working within. Subscribe and share this video. Now let me give you the practical reality of the numbers. For velocity banking to work, you must have positive monthly cash flow. If your income exactly equals your expenses, you have no surplus to apply against the HELOC, and the strategy produces no benefit. The more surplus you have, the more powerful the strategy becomes. A family with a monthly surplus of $2,000 applying velocity banking to a $300,000 mortgage at 7% can realistically reduce the mortgage payoff period from 30 years to approximately 10 to 12 years. A family with a monthly surplus of $5,000 can potentially achieve payoff in 5 to 7 years. The exact outcome depends on the HELOC interest rate, the mortgage interest rate, the income timing, and the consistency of execution. The steps to implement this are as follows. Step 1. Assess your monthly cash flow. Calculate your total monthly take-home income minus all fixed and variable expenses, including your mortgage payment. If you have a positive surplus, you have the raw material for velocity banking. Step 2. Determine your home equity. If you have at least 20% equity, you likely qualify for a HELOC. Contact your bank or a mortgage broker to understand your options and current rates. Step 3. Open a HELOC for the maximum available line. The larger the line, the larger the initial chunk payment you can make to your mortgage, and the greater the immediate principal reduction and interest elimination. Step 4. Make your first chunk payment from the HELOC to your mortgage lender, specifying that it is a principal reduction payment, not an advance payment. This is critical. Many lenders will automatically apply extra payments as an advance on future payments rather than as principal reduction unless you explicitly direct otherwise. Step 5. Redirect to all income deposits to your HELOC account. Use the HELOC as your primary transaction account, drawing from it to pay all expenses throughout the month. Step 6. Monitor your average daily balance and your net paydown rate each month. When the HELOC reaches approximately 20 to 25% of its limit, make another chunk payment to the mortgage and begin the cycle again. I need to be honest with you. Velocity banking is mathematically sound, but carries real operational risks. First, it requires a HELOC rate that is close to or lower than your mortgage rate to be maximally effective. In a high interest rate environment where HELOC rates significantly exceed mortgage rates, the strategy's efficiency is reduced. You are still benefiting from daily balance calculation versus monthly balance calculation, but the rate differential works against you. Second, it requires rigorous cash flow discipline. If you draw from the HELOC for non-essential spending and your HELOC balance grows rather than shrinks, the strategy fails and you have increased your total debt. Third, a HELOC is a variable rate instrument. If interest rates rise significantly after you establish the line, your HELOC payment costs increase and your strategy's efficiency changes. Fourth, not everyone qualifies for a HELOC. If your equity is below 20% or your credit score is below 680, you may not have access to this instrument. Fifth, some mortgage servicers charge fees for extra principal payments or have prepayment penalties during certain periods. Verify your mortgage terms before initiating this strategy. Your grandparents paid for houses in ways that would seem alien today. In some cases, they bought with cash saved over years. In others, they took short-term mortgages that they paid aggressively. The idea of borrowing an amount that would take 30 years to repay and paying more than double the purchase price in total would have seemed like a trap rather than a standard transaction. Then one generation was told that the 30-year mortgage was the normal way, that making the minimum payment was the responsible choice, and that interest was simply the cost of home ownership. It was not the cost of home ownership. It was the cost of the bank's patience. And patience When you know the daily balance calculation is something you can manufacture yourself. There was not a faster way, there was just a more informed way. Subscribe and share this video. Every share shows one more homeowner the mathematical structure that their mortgage statement was never designed to reveal. The next vault opens soon, and what is inside will show you a 5-minute federal action that permanently stops identity theft and costs absolutely nothing to implement. Sex is Zexatilis.